Hey, it's TSLA, and this is episode 399 of the Orange Pill Investor. I am going to cover the Tesla earnings play. No need to rush into it. Generally like to let the market settle for a couple of minutes. But I got to get on the road. So I'll be driving up for the Bitwise event tomorrow, which means no True North tonight. And I will probably not get a chance to record, I assume, tomorrow. And then I'll be driving on Friday. Not sure if I'm going to get a chance to record Friday as well. I guess I could take my laptop and do it from the hotel. Maybe I'll just take that with me just in case. All right, so let's jump into this. This couldn't have worked out any better, and trust me, it does not always work out like this. The profits are pretty small for these Iron Condor plays. However, there's always someone having an earnings call, so there's always a play to be had if you're willing to do the research and dig and find it. So yesterday I decided to try a basically like a Tasty Trade special earnings play. This is pretty standard for them, and this one just happened to work out. And before I even do that, so just to be clear, I went to the expected move, but there's like a 15-20% chance on each side of the trade where this could go wrong. So this probably only works like, I don't know, 60-70% of the time. And this one just happened to work out very well. So you can see that for this Iron Condor, the put credit spread side, I chose to sell the 210, 200 put credit spread. And then on basically the call credit side, I sold the 265, 275 credit spread. And so I'm just going to highlight these. I sold it was close to $300, so $3. So I'm going to close this one. And this is just about as good of an expectation as you can ask for, is to buy it back for roughly half of what you sold it for. And I'm just going to send it. See if I can get this to fill. Nope. And it's a little bit harder to get spreads to fill, and since this has 4 legs, it's going to be even harder. Some people will, when they okay, cool, that filled. Some people will just let this run, right? I mean, this hit almost perfectly. So halfway in between the 265 and the 210 would be like 237.5. So I guess it's a little bit over the middle. But some people will let this run and try to buy it back for even less than that. But I don't know if it's superstition, but it just seems like that's just giving you a chance to turn a winner into a loser. Especially since you can see there was, the stock price did go up. So over the next, especially since there's 2.5 more, well, basically 3 trading days to expiration, even though this landed like very nicely in between my strikes, there's a little bit of an uptrend here. So by the end of the week, could we be at 265 and I'm risking, losing this trade? It's possible. Let's just see my activity. I think I sold it. Yeah. So I sold it for 293. Wasn't able to quite buy it back for half. That would have been buying it back for 146. So I didn't quite keep 50% of the profits here. But that's pretty reasonable. So if, was this worth even doing? Was this worth my time? Let's take a look at the calculator. I kept $1.34, 293 minus 159. Yeah. So $1.34 profit divided by the I put up 1,000, but I could really only lose, since I collected 293. The maximum amount I could lose would actually be 707. So let's see, is that fair to divide by the 1,000? That would be that I could lose, or the 737. Let's just divide by the 1,000. Obviously, that's going to be 0.134. So I made, I risked 1,000 and kept 134. So that's 13%. So that's pretty good. But like I said, you're probably going to win these trades, maybe 2 out of 3 times. And then, if I win this twice, that's $268. But if I lose it one time and lose the whole 70, the 707, that doesn't compete. So, you have to win this more than you lose. So you're going to have, pretty high success rates. And, that winning 2 out of 3 is just ballpark. Like, it all depends on the strikes you choose. So in this case, I chose to pretty much go with the expected move. But for an increased chance of success, you could go all the way to this 1 standard deviation line. Of course, you'll make less money in that scenario, but you'll lose less. So on average, maybe this earns a 0.5% return, right? If you subtract all the losses from the wins. But there's 250 trading days, right? Approximately. So if you made 1.005, a 0.5% raised to 250 days, you might 3x your investment on something like this. I don't know if that's quite reasonable expectation, because as I mentioned, the liquidity is extremely important to be able to get in and out of trades. So you're gonna get kind of screwed by the bid-ask spread on the way into the trade. You're gonna get there's a little bit more friction getting out of the trade. So probably 0.25% profit a day is probably more realistic. I really stopped doing these because it's kind of time intensive too, and you really have to just be there trading them right before the market closes. You have to be ready to close them, probably 15 minutes or so after the market opens. And I think I started trading some stocks that weren't really liquid enough as well, or maybe the using the Kelly criterion formula, they were like cutting it close, but I was desperate to try to trade some things. So this wasn't terribly profitable for me, especially considering how much effort it took. But it was just something fun I kind of lucked into as I was reminded that Tesla earnings were yesterday. So this one happened to work out, but it's definitely not without risk. Definitely, check out Tasty Trade's content for the earnings plays and Iron Condors in general. They've got tons of free research that they share, and go way more in depth than this one little example. I almost kind of hoped that this wouldn't work because with the strikes that I picked, I think there was like a 0.16 delta on one side and 0.2 on the other. This trade should fail like at least 33% of the time, I'm guessing. So yeah, it's not like you should rush out and just make this your entire strategy, right? Like, maybe 1 to 5% of a portfolio in something like this after you get good at it kind of makes sense. But again, the effort that it takes to go and like build a list of highly liquid stocks and keep track of the earnings and place the trades and check to see if it even makes sense with the delta and how much money you can collect, and make sure that the implied vol chart has decent IV crush after earnings. All of that is a bunch of work, and eventually it just wasn't really worth it to me, but it was fun. But yeah, I kind of hoped it wouldn't work so that so that people could see, how that there is some risk here. So I tried it once and it worked, but that's like, flipping a coin and guessing heads. That's not a done deal. So that's the only thing that I really had to even do today. I wasn't even gonna do I was just gonna jump on the road and drive to New York City. But I was like, ah, shit, I did that damn earnings play, which I needed to close right after the open. So what's up, Owl? What's up, Howard? Yeah, I had to, well, I don't set an alarm anymore, since I semi-retired in December. But probably just a little bit nervous about traveling and the Bitwise event that I'm attending tomorrow. I think woke me up at like 6, which was good. Takes me a couple of hours to feed and walk the dogs, and I was able to get steak and eggs in my belly even before the market opened. So I'm ahead of schedule today. What's up, Strategy? Super bullish on Tesla long term. Nice call on your Iron Condor. Thank you very much. Yeah, I am too. And actually, I was a little bit nervous about it because I was like, man, all Tesla needs to do is have like one amazing earnings call, some kind of like positive announcement with FSD or Optimus, just, some kind of good news to just blow this thing out of the water, and my Iron Condor would have gotten completely wrecked. So got lucky with this one. What's up, Joshua? Nice play on the Iron Condor. Worked out perfectly. Yeah, that was definitely some good luck. What's up, Joshy? Let's see. Nice play. It worked out perfectly, especially that poor earnings, but offset with Trump's tariff news. Watching while deployed. Thanks for answering all our questions, man. That is all. Captain Satoshi out. All right, man. I'll give you the Navy greeting then. Fair winds and following seas, brother. Third place math. You say there's a 15% chance of the price ending up on either side of the expected move. That suggests expected move is 1 standard deviation. Do you ever use bell curve percentages as quick math for trades using the 68, 95, 99.7 rule? So I haven't done these for a while. And something that I really need to check is, so Tasty Trade will give you the expected move, the 1SD line. In this case, I went to the expected move. But I was a little bit aggressive with that. And I used to do mostly the 1SD. But you can see here that that delta doesn't really agree. And I don't know how Tasty Trade calculates the in the money percentage, but that's slightly a little bit different than delta as well. From what I understand, if delta was a true approximation of the 1SD, then this should be, 0.16 delta. And then this one should be, 0.16 on the call side as well. And they're not. So I don't know what the discrepancy is between the standard deviations and the calculation for the delta. Let me read your question again and make sure I'm understanding. Let's see. Yeah, and I probably misspoke because I can't really exactly remember what the deltas were when I selected the 210 strike and the 265. I think on the I think on the put side there was like I think it was like 16 delta, and on the other side I can't remember if it was like, I don't know, it was somewhere between 14 and 20. So kind of adding those two together, like if there's a 16% chance of it going below my strike and another, I don't know, 20% chance of going above my higher strike, I kind of just ballparked that into like a 33% chance. Yeah, I don't know how well to actually take the deltas or, the in the money percent as gospel. Anyway, so let me read this question again. Do you ever use the bell curve percentages as quick math for trades using the 68, 95, 99.7 rule? I don't think so. Yeah, not really. So like, let's just say, for example, I was just going to do the put credit spread. And I'm going to sell the 215 and buy the 205. I'll kind of just look at the delta and figure, okay, I've got a 7% chance of losing this trade. But that's only if delta is accurate. And this is at the 1 SD line. So is one standard deviation accurate? Like, should the delta really be closer to 16? I don't know. I don't know what the algorithm is doing with all the numbers. It seems like this should be a 0.16 delta if this is the 1 SD line. So either that's not how the calculations are done, or I just don't understand what's happening here. But anyway, if I was going to assume that delta was accurate, then on a $10 wide strike or spread, I would want to collect more than $60. And so I would kind of look at this and say, well, I can only collect 35. I'm not going to open this spread. That's kind of how I look at it. So kind of using a math shortcut here, but not really the bell curve percentages, no. Let's see, seems like expected move is less than 1 SD. I wonder how they calculate it. Yeah, me as well. maybe I'll have to dig into some of their videos and see if they explain themselves. Howard says, isn't there skew on the delta curve, so you can't use normally distributed bell curve? I don't know, but it sounds reasonable. I can't imagine there's much else I'm gonna do here. So, but I'm just gonna like do a speed run through this whole thing. I gotta get on the road. So let's minimize that. Get rid of my face. Retired Air Force guy that I used to work with said that I had the perfect face for radio. So maybe I should just do spaces instead. There's still a little bit of premium left in this put. About 25% of it. Sold it for 80. There's 20 left. Couple trading days. I can let this run. My 320 strikes are getting properly wrecked. Love to see that. If I only had 100 shares, I wouldn't like it very much, but I have about 2,000 net delta, so there's plenty of long call exposure here. I've got plenty of longs that I can use to pay for this. If it keeps going, I can always dump these poor man's covered calls for these might break even, really. I probably need a push to 400 a share for these longs to actually go into profit. But long story short, I finally have some profitable positions that I can use to exit this trade if I need to pay. Right now, it looks like it would cost me about 10 grand to close these positions. And so for the most part, when I'm selling a covered call and my strikes are threatened or breached completely, my standard operating procedure is just to do nothing. I just sit and wait. The only exception to that rule would be if there's no extrinsic value left. The way to calculate it is you subtract the share price, the strike from the share price. That's going to be 27.50-ish. And that means that 27.50 is intrinsic value. The value of the option is 29.50-ish. So if I subtract the 27.50 from the 29.50, I get $2. So there's maybe, and it just keeps ping-ponging around, but yeah, there might be $150 left of extrinsic value here. So not a lot. You could argue that it's not worth keeping this open, but if I roll it now, I have to pay that $150 to buy it back, and that's just not worth it to me. So I've only gotten exercised early a couple of times, and it's always been like on the Thursday before expiration. I've never been exercised early on a frickin' Wednesday. Not that it couldn't happen. Like if this ran to 400, somebody might exercise those calls overnight, I suppose. So if you're super worried about that, it's fine to roll it. Not financial advice, but I don't panic roll is what I'm saying. If I have to pay this 10 grand, I'd rather pay it on Friday. Tesla. So I went ahead and just in case Tesla did some, amazing things, I went ahead and took the extra covered call off. And so let me just check the activity. I paid $500 to take it off, and for me to put it back on, wait, where is it? May 30th. For me to put it back on would be a little bit less. So it didn't do me any good, really, which is fine. If Tesla had, pushed to 275 or 300 or something, then that would have made sense. But I'm just going to go ahead and, can I open another one? No. Yeah, I'll just put this back on, and basically I just missed out on $100. No big deal. All right, so now I got the two long calls that are in the money. I'm selling the 2 covered calls against, and not much else to do there. Joint account. When did I add a covered call? Yeah, I added this one yesterday. So I think I'm just about covered called out here. It's possible I could squeeze one more in against. Nah, not really. Yep, and Tesla's still doing its thing. Yeah, one poor man's covered call's running. It looks like I have $2,000 in buying power, but I do not. So this vertical that I set up 13 days ago, I didn't realize when Tesla's earnings was before I set this up, but it is close to firing, right? So I sold it for about $2, and I can, I'm trying to buy it back for just under $1, and it's worth 120. I could just close it now and call it good, and keep the 75, $80. But I'm just gonna let it sit. If it sits for another week, maybe I'll take profits in one of them and then roll the other. I'll have to take a look at, let's just see if I was gonna set one today. Yeah, the 45 days to expiration is not even available. They haven't filled in the early June dates. So the only way this would make sense is if I went to 60 days, which is a little bit annoying. But let's just say I go to 250, 240, and there's, it's easy math to do, $1,000 call. So in this case, if I use Delta, then this makes sense because I would need to collect at least $120. The Delta times 1,000, and I could get paid 157 here. But if the in the money percentage is accurate, then I would need to collect at least $200, and this wouldn't quite cut it. So depending on what you want to believe, and then where's the 1SD line? Yeah, if one standard deviation is really supposed to be 0.16, I doubt I can get that up here. Yeah, not even close. If the 1SD line was accurate, it wouldn't really be worth opening this spread unless I could collect $160 or more. So just kind of keep in mind, like Delta, in the money percent, the 1SD line, I mean, these are all just kind of estimates and projections. It doesn't mean that if you run the 215 strike, it's going to win 84% of the time because it's 1SD. If their model is accurate, it should be pretty close, but something's got to be wrong here, right? Either Delta is wrong or the 1SD line is wrong. The 1SD line matches up much closer to the in the money percent here, If 1SD is 16%, this is a lot closer than the delta number. So I don't know if delta is being affected by IV crush as well. So if you noticed a theme there, there's a lot of I don't knows in what I'm saying. So, but anyway, long story short, I'm going to let this run and try to collect the full amount, the full 50% of the 100%. All right, same thing here. So this is the challenge account. My 335 strikes getting wrecked, 365s holding steady. My 350 that I've had on for 15 days is getting blown out. So I will probably have to wait on this one. It's like almost in the money, but there's still, $3,000 worth of extrinsic value left here. So probably won't do much. If I tried to roll this now and rolled it out, yeah, I'd have to roll it out to like 58 days. Let's see how high I could roll it for a small credit. I could roll it to the 385. I could roll it to the 390 and probably not have to pay. So 375 would be pretty easy to roll it. So I'm still not in the danger zone here. Which is one of the benefits of selling the out of the money covered calls, is it gives you more room to roll out and up. Whereas, if I try to roll these ones that were, kind of just slightly out of the money, if I try to roll the next week, just to keep a credit, like a tiny little credit, I can't even roll out of the money. So I'd be rolling in the money. So anyway, yeah, you're taking a lot more risk with the weeklies, especially when you're not rolling them significantly out of the money to begin with. But I could probably be a little bit less risky with this account now because I've taken off some of the leveraged positions. But I had painted myself into a corner because I had so many poor man's covered calls and I had so many of these leveraged plays. Like all of my September 1080s adds up to, negative theta of 270. And just one, it would take two of the weeklies near at the money to compensate for that. So in order to keep this a net positive theta, I kind of had to plow into some of these weeklies because the theta on the out of the money ones just doesn't cut it. It's only 50. And in the case of these, it's like closer to 40. But yeah, now that I've taken off some of these leverage positions, and it looks like I can even take off a couple more. These are pretty well in the money. So maybe I'll do that on Friday as well. I could take off 3 of the poor man's covered calls and buy another 100 shares. I like the sound of that. But no rush. I can do that when I have to pay this $1,500 on Friday. All right, check the 5K account real quick. Not much left in this CLSK put. Sold it for 13. There's 3 cents left. That's about 25%. So I've collected 75% in one day. So yeah, it's time to close this. Same thing's probably going to be true for this Riot $5 put. But is this the one that I sold? This is for 530. Okay, maybe not. The bid-ask spread is, okay, it looks like it's 1, but that's just a bad calculation because the bid-ask spread is 0 to 7. So that's not true. It's not really 1. If it was really a penny, I would close it or roll it, but it's fake news. Just means the liquidity on this $5 put is not good. All right, so since I closed that CLSK put, I've got $1,200 in buying power. So if I still like CLSK, and I have the buying power, I can just move this to the $9 strike if it makes sense. And I can collect 22 bucks, which putting up $900 in collateral, 1% of 9 would be 9 cents. And so that would be 1% return on capital. 18 cents would be 2% return on capital. So this is a little bit over 2% for half a trading week. So I like those odds. Doesn't mean that CLSK can't, collapse to $7 by Friday. And if it, if CLSK dropped to 450, then my capital would, I would have still gotten 2% on the value of the capital as it's valued today, but my capital would drop in half on Friday if CLSK goes to 450 a share, right? So when I throw around these return on capital numbers, it's not overall portfolio value, right? My overall portfolio is not going to go up by 2% this Friday if my stocks that I'm long all crash. So don't want to seem like I'm misrepresenting or like over promising, the types of returns that you can get. But that's just the kind of mental math that I go through when I'm deciding what positions to take and is it worth my time. All right, that's everything I think I need to do today. So let's check chats and call it good. All right, Dude Face, I had an Iron Condor going for earnings on Tesla as well. There's good premium there and 9,000 Bitcoin, so they count. Yeah, exactly. I'm so bullish on Tesla. I just love the fact that they have owned some Bitcoin. Kind of broke my heart when they sold some back in the day. I was like, what the fuck? That doesn't even make sense. But maybe at that time they weren't really getting credit for the value of the Bitcoin. Like, if they wanted to, I don't know, get a loan to build a factory and buy a bunch of land, maybe they weren't getting favorable terms because they were discounting the value of the Bitcoin or something. They could have a bunch of reasons for doing what they did, but yeah, I love being able to use their Bitcoin holdings as an excuse to be long Tesla. Deeply, thoughts on MSTR Iron Condor dated May 16th with break evens at 287.95 and 447.05. I don't even have to look. My personal answer is probably going to be no. So IV rank is still low. Tasty Trade's like minimum threshold here is like 25. 50 is better. Above 50, obviously, the higher it is, the even better it is. But so IV is low right now, so I wouldn't want to be selling Iron Condors in it necessarily. But the main reason doesn't even have anything to do with the implied vol, because if the premiums seem worth it compared to the deltas, or whatever you're using, all of the times that I've tried to get MSTR credit spreads, May 16th. So that's for right after, is that for right after earnings? What's the rationale for even wanting to set this up? Like, strategy is going to be with the most volatile stocks. Iron Condor seem pretty risky. So 287 and 40. Where are you getting the .95? Is that European options or something? 287.95. Oh, the break evens. So what? Something like this. And 44.7. Oh, so that's way higher. That's like way past the 1SD. So sell the 445, buy the 450. I don't like it. I don't like the amount that the credit that I'm seeing here. I'm thinking I'd probably want to see, let's see, 16 on the put side, and good Lord, and like 12 on that side, so 28. Yeah, I need like $300, 280, $300 here. But the real problem is this giant bid-ask spread. So 50 to 190, $1.50 wide bid-ask spread on a $5 wide Iron Condor. It's going to be too hard to get a fill getting in, and then even if you win, you might get screwed $25, $30 trying to close it for a profit. So I've tried to make spreads work on strategy, but even as highly traded as they are, the bid-ask spreads are still just terrible. Misty closed some of their in-the-money synthetics on Monday and rolled the leverage into more on the 330s. That was while the 330s were still out of the money. They are learning. Are you rolling those strategy covered calls? Nah. Generally, when my strikes get wrecked, I just do nothing. So I'll wait till, for the most part, I would say I have a 95% chance of not getting exercised early if I handle this before noon on Friday. So I generally don't bother. 455, 445 is 282.90. Yeah, I just don't like the liquidity. IV makes it hard to exit in case the price runs against you, you mean? Yeah, because if the price runs, strategy's IV is going to spike, which is going to make your Iron Condor more expensive. So you're really running into two headwinds. The IV, if the price pumps higher, IV is going to spike, and you're going to be approaching that higher wing of the Iron Condor. So I just think it's between that and the poor liquidity, it's just hard for me to bring myself to do anything with spreads with strategy. Yeah, an increase in IV is gonna go against you. If IV rank is 22 now and we got a run to, what was it, the 455? Yeah, if we got a run to 450, right in the between your upper strikes, like you're winning just barely. But if IV pumps, like, it's just going to be hard to exit that position. I think. You know, up here maybe, when you see an IV spike like this entering into some kind of put credit spread might make sense. But then, you know, we're in a correction here, so the danger is to the downside. Would you take that range for this Friday? Seems high probability and just pocket the premium. No, no. The liquidity is too bad. I can't, like, even if you, yeah, I'm just, yeah, I'm not making that bet. Not in a low IV environment. Low IV environment and for liquidity, that's like two things that you want to see selling any kind of spreads. So, no, I wouldn't bother. All right, that's it. I am going to get on the road. I got a bunch of podcasts in my saved folder to get me through this 3 or 4 hour drive to New York. No show tomorrow, no True North tonight. And if I'm lucky, I'll be able to record on Friday. Otherwise, I'll just have to trade on my phone or something. So, all right. Thanks everybody for tuning in. Be good, Joel.